All right, good evening, everyone. My name is Xavier Duran. I am the Arts, Culture, Educational Programming Librarian for the Lisle Library District. A couple of things before we begin. You are more than welcome to type in any questions that you have in the chat, and as Judy's going along, she will go ahead and answer those. Additionally, Judy wanted me to tell you about her newsletter, the tax newsletter. There is, if I remember correctly, you said there's one that's going to print, after which you can download all future newsletters from her website. The website for Judi Strauss is located in the chat window. So that's how you'll go ahead and get future tax newsletters. With that said, let me go ahead and if anyone's asking about tax forms at the library, currently we have the Illinois 1040 as well as the 1040 instructions, and we have the federal 1040 for the time being at the Lisle Library District. We should be receiving more as they roll out over the next couple of weeks. Of course, it's a little complicated, so luckily we have Judi Strauss here to answer any and all questions. Judi Strauss is the owner of Strauss Tax Service. Since 1969, she has been providing personalized tax and financial planning services to individuals and small businesses. Judi holds a PhD from the Union Institute and a master's degree from Harvard University, and was a professor of human resource management at Benedictine University. She is an enrolled agent licensed to practice before the IRS and is a member of the National Association of Enrolled Agents and the National Association of Tax Practitioners. With that said, I'll go ahead and give the floor to Judi.
Thank you. First of all, I see you're all video muted. I would love to see who you are. I loved coming to the library and talking in front of you. So if you want to put yourself on, I would be thrilled to do that. Thank you. Hello, Cindy. I see Cindy. I am thrilled to give back. I lived in Downers Grove for over 50 years. And as many of you know, my husband passed away and I sold my Downers Grove house, but I'm still doing taxes and we're still working with the many clients that I have in the suburbs. That said, this is probably the weirdest tax season that I've ever going to deal with. And I want to tell you why. First of all, as many of you know, the IRS has a terrible backlog. The IRS has been working to resolve this backlog, but the IRS lives with hardware and software from the 1990s and Windows 2000. Anything that shows up at the IRS in paper takes 6 to 9 months and maybe a year. I have one client that filed in paper. It took her 1.5 years to get her refund. So the IRS is in a terrible mess. Their backlog is getting better, but it's still pretty bad. E-filing started on Monday, but I am recommending really strongly that you do not start your tax return until you have all of your records. It's one of the things that the IRS is really good at is matching what they get from all of your people that send you W-2s or 1099s and the ones that you get. Often I say, somebody says, oh my God, Judi, I want to file early. I need the refund. Let's file right away. And I always tell them to wait. Most of us have our 1099s from Social Security. Some of us have our things from our investment accounts, but many of us do not. Some of us have our 1099-Rs from our pensions or our IRAs, and many of us do not have them. Some of them show up in February, and some of them also show up in March. The other first thing that I really want to tell you, and people are really worried about it. In fact, if you really want to watch the news, I was on Channel 5 at 5 o'clock today talking about this. For 2 years, we have had big stimulus checks. You got them in the mail, you got them in your bank account. Those of you that had children got big child credits, and some of them were advanced child credits. Those are gone. The other thing that's gone that people really liked was when they got unemployment, the first $10,200 in 2020 wasn't taxable. All of those stimulus payments are gone. Many people really expect to get a smaller refund. They don't like it, but the IRS is really assuring people that they may get smaller refunds than in past years, because a lot of the incentives, even though you and I may not think COVID is gone, and most of us may wear our masks or may not wear our masks. I'm in Chicago now, and when I go on the bus, I still wear my mask, but a lot of us aren't, and the incentives from COVID are already gone. So the first thing that I want to tell you is the backlogs, okay, were 4.7 million backlogs of paper tax returns at the end of 2021. They are now down to only 400,000 in backlogs at the end of October of 2022. And if you ever looked at pictures of the IRS cafeteria, they're all lined up in files waiting to be keyed in. Okay, they also have amended returns, and those amended returns are now down to only 600,000, okay, from 2.4 million. The worst is, and like I was telling you, you want to make sure that you have all of your 1099s, that if you get a letter from the IRS, and whether you write them, or you hire me, or you're my client and I write them, their correspondence backlog is still 5.1 million pieces of paper. That means if you sent in a letter responding to an IRS notice, you might not hear from them from 6 to 9 months. Or you might get a letter that says, guess what, we're still working on it. So I really want you to make sure that you e-file your return, that you have all your documents, and that you at least try and understand the tax laws. So let's talk about, and let me see if there are any questions yet. I don't see any questions yet, but please make sure you ask me questions. The first things that are new with 2022 returns. In 2020, many of us were required to take what we call required minimum distributions. That means we had our IRA, we had our 401k from our from when we worked in our retirement account. It got rolled over to an IRA. When you were 70 and a half, which I am older than that, you were required to take them out. When you take them out and they're what we call pre-tax, not a Roth IRA, but a regular IRA, they're taxable, just like your wages would be taxable. And the way they figure what you have to take out is based upon the value of your IRA at the end of the year and an IRS life expectancy table. Okay, so if you're 70 and a half, they figure you're going to live 27.4 years, and it gets divided by the value at the end of the tax year, and you are required to take it out. In 2020, they suspended the RMD. In 2021, it came back. Okay, what they did in 2022, however, they raised the age from 70 and a half to 72 years old. So if you had already started, which I had, and you were 70 and a half, you couldn't stop, okay? But if you weren't 72, you could wait until 2022. So this is just tricky. And in 2021, and also In 2020, the stock market went like this. So a lot of us had a lot of required minimum distribution to take out. It sits in the middle of your tax return, whether you needed the money or not. Some people need the money and some people didn't, but it really screwed up your tax return. What they did at the end of 2022 is they changed the RMD again. And what they said is that if you turn 72 in 2023, you can wait yet another year to start taking out your required minimum distributions. So it's very confusing, but you are required to take out the distributions. Now, one of the problems that's really interesting is, as most of us get older, sometimes we forget. I have clients that forget all the time, and they get hysterical when they come in my office. The IRS has had a penalty on the books that says that if you forget, the penalty is 50% of the required distribution. As long as I've been in business, which is a really long time, they have never enforced that penalty. If I have a client that forgets to take out their RMD, we tell them, take it out right away. And if you ever get a letter, which we've never gotten, I just say, as soon as they forgot, we took it out and you've forgotten your tax. They've now reduced the penalty from 50% to 20%. And if you remember to take it out right away, it's now only 10%. So this penalty is a crazy thing, but people get hysterical about it, and it's not a big deal. The other thing that I want to tell you about is a lot of people have their IRAs in one place. They have their 401ks rolled over in another place, or they have several different IRAs. You can take out your required minimum distribution from one, you figure out how much all of them are worth, and you can take it out of one, or you can take a little bit out of each one. It doesn't matter, as long as you take out the required minimum distribution. And usually, if you're sitting in my office or you're my client, we figure out how much you have to take. And often we figure out how much tax you have to take out of it, because it can easily screw up your tax return. Now, a really simple way that's been in effect since 2017, and is an important thing for you to hear, whether you've done it in the past or you should do it in the future. Because the IRS changed the tax laws in 2017, they doubled the standard deduction and they got rid of all the exemptions. Lots of people, and we'll talk about medical in a little bit, but lots of people aren't itemizing their deductions. In 2020, we were allowed to deduct $300 of charity, even if we didn't itemize and we were either single or married. And in 2021, we were allowed to deduct $600 of charitable contributions on the front of your 1040, even if you didn't itemize. That's gone. Okay, that is gone. The charities need our money, whether it be a charity, whether it be your church, whatever it be, whether it be your kid's soccer team, okay, whatever it is. My husband's favorite charity was always the Salvation Army. One of the best ways to save tax money is called qualified charitable distributions. And what that means is you take money, or the trustee, whether it be Vanguard, Charles Schwab, Fidelity, it doesn't matter, Morgan Stanley, and you make your donation not from your checkbook, but directly from your IRA trustee. So if you go to church and you used to give money every week in the basket, it's better to write a check to your church from your IRA trustee, and then we subtract it from the amount of your required distribution when I do your tax. It is really a wonderful way to save tax. It's a win-win. It's a win for the charity who needs the money. It's a win for you, because you save less taxes. What people get scared about is their form, and the form for IRAs, and this isn't true of a pension, it's only true of an IRA. It comes on a form called a 1099-R. And the 1099-R has two parts in it. It's called gross distribution and taxable distribution. People get scared. The numbers are exactly the same. When I do your taxes or you do your taxes, there's a box on the computer program that says QCD, that stands for Qualified Charitable Distributions. I open it up and I say $500 to the church, $1,000 to the food pantry, $500 to the Hinsdale Humane Society because I have cats. Okay, and then the computer will automatically subtract whatever you give from your R&D. That's a pretty important thing. So this is how the IRAs work, and it's really important. A second thing that's critical, I just told you that you had to take out your IRA. Let's assume that you have a spouse, or you inherit an IRA from an uncle or an aunt or whoever it is, okay? And that IRA, they've been taking it out, it becomes an inherited IRA. There are different rules for inherited IRAs than regular IRAs. If you are a spouse, like I was when my husband passed away, I can take it out, like I was telling you before, a little bit at a time. If you are a non-spouse and you inherit an IRA, you have to clean out that account within 10 years. Okay? Right now, you don't have to take it out every year, but you have to clean out the entire account within 10 years. So that's a really big thing. And people are scared to do that because as soon as you take it out, IRAs are taxable. Okay, IRAs are totally taxable. So that's the IRA piece. A couple of other things that I want to remind you about, okay, for 2022 and also for lots of other years. You have a couple of different kinds of income. You have two kinds. One's called wage income, one is retirement income, and the other is investment income. Wage income and retirement income is taxed at what we call ordinary income, or the highest possible tax rates. Okay, so that, and that's also true, and we'll talk about it in a minute, of Social Security, but that's called ordinary income. If you've got money invested in Fidelity, in Vanguard, in Charles Schwab, in Morgan Stanley, in Merrill Lynch, wherever you have it, there's often 2 or 3 different kinds of things that show up on a form. And the form you will get from those investment people is called the 1099 INT, 1099 DIV, and 1099B. That stands for interest, dividends, and sales. So you may indeed own stocks or bonds or mutual funds in those investment accounts. And those are the ones that usually show up pretty darn late. The interest is taxed as ordinary income. If you have dividends from stock, or if you have gains from either sales of stock or sales of mutual funds, or if you get something that's called long-term capital gains where the mutual fund sold things, those are taxed at a lower tax rate. If your income is low, it's taxed at 0. And if your income is higher, it's taxed at 15. If your income is way higher than most of us have, it's taxed at 20. But the long-term capital gains is a really good way to save on tax money. Now, the problem is, and this is an interesting problem, if you go back and you look at your tax return even from last year, The mutual funds that you own, you have no control of when things are sold in that mutual fund. The mutual fund manager decides when they're going to sell. So you open up your year-end statement, or you open up your 1099 from your broker, and you say, what the H? I don't have that money in my bank account, and now I've got to put another $10,000 or $15,000 or more. It's called long-term capital gains on your tax return. That happened a lot in 2021. I mean, a whole lot in 2021. If you go back and look at where all this money came from, because the stock market went like this, and the fund managers correctly thought the stock market was going to go like that. So they sold a lot of things at the end of the year, and you have absolutely no control over what's going to happen. Okay. I have a client, a really cute client who now lives in Las Vegas, but he's still my client. And he was smart enough to sell his Tesla, okay, near the end of the year. And he's going to pay tax on the money, but at least he didn't lose it when Tesla went down. So that was 2021. A lot of people say, hey, 2022 was not a very good year for the stock market. So I really hope that I'm not going to have these capital gains like I had before. Well, that may or may not be true, but a lot of people got really scared. And so what they said was, I'm going to pull my money out of mutual funds and I'm going to put it in income producing things like interest, or a lot of people were buying these savings bonds that for a while were paying 6 and 7%. Okay. At least for the first year. And so if people sold things from the mutual funds or cashed them in, then the mutual fund had to sell things to give people the money. And you may be surprised that you're going to see capital gains, even though the stock market did this. And so I haven't seen it yet, but that's one of the problems with mutual funds. So that's where that has gone, and you'll have to wait and see what happens. Most of those don't show up until the middle of February. Now, the second thing that changed, which is really dramatic, okay, in 2022 and beyond, I want to tell you, and that's energy credits. The energy credits used to be a pretty small thing. We used to get a new air conditioner, we used to get a new furnace, we used to get new windows, and you'd come into my office and you'd say, oh my God, I just spent $10,000 on windows, or I spent $5,000 on a furnace. And I'd say to you, all right, please tell me if it's energy efficient. Energy efficient means you have to meet certain guidelines on the website. It's called www.energystar.com. I'm looking to see if there are any more questions. I don't think so yet. Energystar.gov. And if it is, then you were eligible for a certain amount of energy credit, $200 or $300 or $400. The energy credit until 2022, okay, was limited to $500 total. Okay, and had a certain amount for windows and for doors and for other things. And so, and it was only for the taxpayer's main house. Starting in 2023, okay, this credit, which was called the energy credit, is now has a different name. It's called the Energy Efficient Home Improvement Credit. And the lifetime limit no longer applies. So this is the annual limit is $1,200 per year. It's huge, but there are specific limitations on the amount for windows, doors, water heaters, air conditioners, and furnaces, as long as they meet Energy Star requirements. So the good news is it's a win for the environment, and it surely is a win for you. The other thing that's awesome in this, that the energy credit has now been expanded not only to your main residence, but also to a second home. Okay, but also to a second home. And this is pretty critical. So we may see a lot more people taking energy credits. Now you need, when you do that, you need to make sure that it's Energy Star compliant. So you need to ask, okay, you really need to ask what's happening. And so this is incredibly critical. Okay, so you want me to say the name? It's called the, hold on, I'm coming back. The name of the credit is called the Energy Efficient Home Improvement Credit. And the website is www.energystar.gov. So when you go to buy something, you know, you need to look, and it should say, there should be a sticker on it that says it's Energy Star compliant. It's a win-win because it really saves you electricity, okay, or whatever it saves. Usually it's electricity because it's energy efficient, and you're going to get a huge tax credit. This is a big deal. So again, you can also use it for your second home as well as your main residence. So those are, is there somebody else that has a question? Hold on. Okay, I got that. All right. You can keep asking me questions. I love it when I do it in person, but people aren't asking me questions anymore. Okay, so the other things that I wanted to tell you are the things that are sort of gone. So I told you the lower rates are still there, and that's really good. Okay, thank you. So the other thing that's important is these child credits. The child credits went back. They went back only to $2,000 per child. They were all the way up to almost $3,600 per child. And then when the kid hits 17, just when you need to send them to college, the child credit is gone. There is still an education credit as long as your income is below a certain amount, okay? But there's also a $500 credit for each dependent who is not a qualifying child. So we have a lot of clients now that are supporting their elderly parent that doesn't have much money. And you can get a $500 credit for them or for a disabled adult child, as long as you prove that you are paying more than half of their support. Something else that we're seeing a lot of now has to do with houses. And this is an interesting thing. In Downers Grove, in Lisle, we all bought our houses. My house in Downers Grove, believe it or not, I bought for $47,000. I won't tell you how long ago, but I will tell you I bought it here and I sold it way up here. They changed the laws, and people ask this question all the time. They changed the law a long time ago on principal residences. And this is an important thing to know if you're thinking about selling. Okay, number one, the law used to be a long time ago that you could exclude $125,000 of gain. They changed that law. Okay, here's what the law is now, and this is important. If you are married and you've lived in that house for 2 out of the last 5 years, as long as you don't have more than $500,000 worth of gain, then none of the profit in your house is taxable. I'm going to say that again. None of the profit in your house is taxable. If you are single, that amount is $250,000. So what do they mean by profit? Here's what they mean by profit. You start with this closing statement on the house that you sell. You subtract. No, the energy credit doesn't expire, somebody asked, until 2033. It's good for 10 years. So you've got a long time to do this stuff. They gave you 10 years and they'll probably continue it. And I'll talk something else about energy in a minute. I forgot about cars. Anyway, so if you sell your house, you start with the closing statement, you subtract the expenses of the sale, and you get what's called the net selling price. Then you start with what you paid for that house. I told you I paid $47,000. And then you add everything in that house that increases it in value. A new furnace, a new air conditioner. You've redone your floors. You've redone your kitchen. You've done landscaping that's made it better. You put on a new roof. It's not a repair, but it's anything that increases the value of the house. I got a lovely new front door before I moved. Beautiful, cost me a fortune. Okay, so if you take your original cost and add the improvements, that's called the basis. The difference between the net selling price and the basis is your profit for the IRS. And if that amount of money is less than $500,000 if you're married, or $250,000 if you're single, then that is not taxable at all. Now, if you lived in California, or if you owned your house as long as Strauss owned her house, I'm single, that house was mine. It wasn't mine and my husband's, because he lived in a different house in Orchard Brook, which he sold and moved into mine, and then we moved to Chicago. I had more than $250,000 worth of gain, and that is what's called long-term capital gain, taxed at this 15% margin. It is also taxed, and this is the other thing that people forget, it's taxed not only by the federal government, but then you get stuck taxing it by the state. Now, the federal government gives you this break of 15%, but one of the things that I want you to remember in the state of Illinois is that our tax is still a flat tax. It is 4.95%. So people that have long-term capital gains from mutual funds and profit on their houses, they look at their Illinois return and they go, oh my goodness. And all of a sudden they don't realize that they owe money that they didn't think they were ever going to owe. But again, you made money, and so that's a good thing. Now, a lot of people may not want to do this. I did this with my house, but this is something I'm going to recommend for people, and they may want to think about it. So I made a lot of money in my house, okay? I didn't itemize my deductions because I had more with the standard deduction, and I gave my charity away from my IRA. And I said, you know, God is really good to me. I took a chunk of money from the profit in my house and I put it in something in Fidelity, and you can do this not just in Fidelity, but any place, called a charitable gift fund. So you could take money, you can take stock, you can put it in a charitable gift fund. You're not giving it to charity now, but it's sitting there in this fund, hopefully growing. When you donate the money to the charitable gift fund, it counts as part of your itemized deductions. So I was able to itemize my deductions because I put money in my charitable gift fund, and it made it more than the standard deduction. This is a good way to do it. What do I figure? I'm going to leave the money sitting in that charitable gift fund, and some year when I stop working, then I can give the money away. Okay? And hopefully it's grown, because I want to give it to charity, but I don't need to give it all right now. So it's just sitting there, and that's kind of a nice thing to do. So it's called a charitable gift fund, and you can put it away, and you can you know, donate it now to the gift fund and give it away later. You could also do something else with donations, which I strongly recommend, and I have a client who just passed away that did that. And that's that if you have things in your investment account, one of the things we really didn't talk about, but if you inherited stuff like stock and you have absolutely no idea what the cost basis is, or maybe you bought it a long time ago and it's worth a huge amount of money and you're not ready to sell it now, what happens if you give some of that stock to charity? You can count as a donation the fair market value of that stock or that mutual fund. Okay, so if you want to give it away and you may not need it, or you have no idea what the original cost of it was, maybe it split and split and split and split, like some of the AT&T that most of us got way before 1984 when AT&T broke up. Okay, this isn't a bad thing to do. You can give it away and it's a win-win. And maybe you do it all in 1 year and then don't do it the next year. So you can itemize for 1 year and not another year. We'll talk about medical in a minute. Does somebody else have another, is there another question? Oh, no, somebody, I answered that one. So that's the charity stuff, okay? And so this exclusion on the profit of a principal residence is big. Now, on the flip side of this, when we talk about itemized deductions, and I do want to talk about them more than just a little, because one of the things that happens, so you really get this, is that people say to me, I'm not going to itemize. I don't have enough to itemize. We'll just take the standard. I don't want to look at it. And then when I start questioning, they say, oh, you know, all of a sudden, I had a huge dental bill. Or, oh my God, I moved into a retirement home. Or I bought hearing aids, or something happened. One of the things that I really want to spend more than a little bit of time talking about is medical. Okay, and medical is at the top of this itemized deductions list. And medical includes a lot of things you may think about and a lot of things you may not think about. First of all, medical includes either if you pay your own insurance, not if you're having it done pre-tax at work, okay? But if you're paying Medicare plus a supplement, okay, the Medicare is a deduction, the supplement is a deduction, your drug insurance is a deduction, and maybe you also have long-term care. That's all insurance. All of that insurance is a deduction. You may have out-of-pocket expenses for medical. You have drug expenses, and you can go to the drugstore, whether it be Osco, whether it be CVS, whether it be Walgreens, they will give you a complete printout of what you paid, okay, for the year. But you have to go and they will print it out for you if you've done it. Costco does it also. So there's drugs. You also may have a deductible and a copay on your insurance, depending, and I'll talk a little bit maybe about different kinds of insurance, but again, a lot of us are surprised that all of a sudden we're paying. I have a client who broke a hip or something else. Oh, hold on, there's a question about a electric car. I'll answer that in a minute. That was part of the new thing, and I'll answer that. Let me go back to medical. And so a lot of these things, people are surprised at how much they're paying. I'm not going to make a judgment about whether you want to use a regular Medicare supplement or whether you want to use a Medicare Advantage plan, but a supplement, a regular supplement, usually you pay more on this side and then you pay almost nothing on this side, whether it be Blue Cross or something else that's Plan F, which I have, and now is called Plan G. But a lot of people have Medicare Advantage plans, and they have big deductibles and big copays. So you may have that. Unfortunately, none of our dental bills are covered at all. So if you're lucky, you go to the dentist twice a year and you pay several $100s and you say, thank God I don't have anything. If you go to the dentist and he looks at you and he says, oh, you need a root canal. Oh, you need an implant. We're looking at not just 1,000, but maybe 2,000 or 3,000 for each implant. Or you then wind up with gum surgery. And believe it or not, most of the dentists, including mine, don't let you walk out the door without putting it on a credit card or writing them a check. So I had a client with $30,000 worth of dental bills one year. And it's better to pay it all in 1 year and get it over with. So that if one thing that can happen with the dentist, you say to him, hey, if I pay you up front, how much of a discount do I get? And even if you put it on a credit card, at least, God forbid, it's all on 1 year, and you're not splitting it up between last year and next year, and then you can't itemize it either year. So the dental bills turn out to be pretty substantial. Another thing that seems to cost a lot, and I don't know, I don't remember if they've changed it, but hearing aids cost anywhere between, good ones, between $6,000 and $8,000. They're outrageous, okay? And I had a client several years ago, he had hearing aids 1 year, and then the next year he came back with more hearing aids. And I said, what happened? He said, oh, the dog ate my hearing aids. I said, well, that's pretty bad. And so those are deductible. The last thing that's deductible, and this is a very important thing, whether it be you or your parents, and it also gets back to the home issue, is that a lot of people are selling their houses and moving to retirement communities. That may mean an individual house in a retirement community like Caroline. It may mean a place like, I don't remember what it's called now. It used to be called Fairview Village. Now it's called something else. Oak Trace is what it's called. Or you may be in like an apartment building, and you may be either in independent living or different levels of care. Each one of the retirement communities has a different medical issue and a different medical deduction. There are some of them, and I'm not going to say what I agree with, but there are some of them that ask you to buy in. You actually buy an apartment. So maybe you sell your house for $300,000 or $400,000, and you put that in to the retirement community. That is called a buy-in, and a certain percentage of that is considered lifetime medical care. You get a letter from the retirement community, and I can take that as medical. It's a lot. And it's usually just a one-time thing, but it's a lot. You may also get a letter that says, even though you've paid that, you're paying a monthly fee, and a certain percentage of your monthly fee is for room and board, and the rest of that is considered medical. I need the letter from the retirement community so I know what I can deduct. Most retirement communities, sadly to say, cost anywhere from $5,000 to $8,000 a month. And if we talk about 5 times 12, we're talking about $60,000 a year. You can see that you should be able to itemize with your medical that's above 7.5% of your income. I have a client now, she's in her 90s, I'm trying to remember, and her son, I deal with kids all the time. Her son called me, she now has full-time care because she can't do 2 out of 5 things of daily living, and she's paying over $100,000 for round-the-clock care in a retirement community. And so, one, she can deduct all the medical, and two, then her taxes become zero because the medical is so huge, it wipes out all of her income. So I do want to remind you to not think about don't say to Judy, hey, I can't do any medical. I tell people to look at it for another reason, to see what you're spending, because you're absolutely flabbergasted when you get to the end of the year and you say, oh my God, no wonder I feel like I don't have any money. Here's where it's going to medical. Now, if you have long-term care insurance, and long-term care insurance pays part of the fee per month for the room and board, then we have to subtract what you get from long-term care. But long-term care is very expensive now, and a lot of people can't afford it. So I really want you to look at this whole issue of medical and charity and itemized deductions, because you may think you're not going to have it, but you'd be surprised how much you have. Now, a lot of people, and then I'll get back to this question about cars. A lot of people choose, or parents really want to stay in their house. And they really want help in their house, okay? Because they don't want to go and spend all this money in a retirement community or in a nursing home. And what happens is they look at the price of somebody from an agency, and it's $30 an hour or something awful, $300 or $400 a day, and they go, oh my God. And then they talk to Joan, and Joan says, you know, I have a wonderful friend, and she's from Africa, and she's been doing this on the side for a long time, and she did it for my friend, and she's wonderful. The only issue is you have to pay her cash. If you pay somebody and you don't do it, what I call on the top of the table, and you're doing it under the table, we can't deduct it as medical. We can't deduct it as medical. So the other part of that, and this is not a tax issue, but it's really an important issue. If you have somebody from an agency, they have insurance, they have liability insurance if they fall, if something happens in your home, okay, they're covered. If you pay them and they are being paid cash, who's under the hook? You are. I have an older client's mother, and she's gone now, and the caregiver from an agency fell down the steps doing the laundry. It was a disaster. Eventually, the insurance, the homeowner's insurance and the agency's insurance paid the woman. But she tried to sue the woman's estate after she died for a whole lot of money because she's incapacitated. But she fell down the steps, and you could have lost all your money if you weren't paying her through an agency. So the medical thing becomes really, really important. Okay, I saw there was another question. Let me see what it is. Okay, hold on. So there are two questions. The first question, the second question I'll answer. It says, I inherited an IRA from a non-spouse in 2015. I have been taking RMDs yearly. The 10-year doesn't apply to me, right? Yes. Okay, the 10-year only applies to new people after, I don't remember which year, but yes, you have to take it yearly if you've gotten it earlier. So that's correct. You have to take out from an IRA yearly. The 10-year rule doesn't apply to you. So that's true. Okay, the second question that I see here has to do, so there was a credit for electric cars, and most of us looked at electric cars and we thought about two things, whether it be a Prius or a Tesla, or now there's Fords, and I don't know what else there is. There's somebody's Volt, and we thought, oh God, I'd love to have them, but they seem to be very expensive and they seem to be a problem. And so not many people did them. Every time I go on the street now, there are a whole lot more electric cars, and you can always find them because in Illinois anyway, there's a big E on the license plate. And so there was a huge $7,500 credit for electric cars. Okay. The electric cars, the way the credit used to work was that when they sold X thousands of cars, and I don't have the number, of a certain model, then the credit was gone. So you really needed to watch whether you were buying a car where you weren't going to get a credit. Okay, and it really wasn't income limited. So now you need to look at whether the car numbers have been reached or not, and you should be able to get, the person was asking, should be able to get the credit. As long as you got it in 2022, then you should be able to get the credit. But there's a form for that. And again, you need to check it to make sure, and it'll tell you, it'll ask the model and the VIN number and all sorts of information. And if the number of cars of that model have been reached, you can't do it. The good news is the electric car credit has been expanded, and the limitations starting in 2023. Okay, so now, and so again, you're going to be able to get this really big credit, and it's not only on new cars, but it's also on used cars. And sometimes the used electric cars are really a much better value than some of the new ones. So I don't remember, I don't want to go into my computer and look, but I can tell you if the person that asked the question shoots me an email. My email is Judi, Judi @StraussTax.com. I'll look up the car that you're suggesting, and I'll tell you what the form is and whether you're eligible for the credit. But those credits are really big, and that's something really, really, really important. Let me just see what else I want to tell you. Hang in there. Energy credits, R&D age, stimulus, charity. I think wait a minute. I can tell you about this energy credit thing. Hold on, let me see where the cars are. It's the credit phases out after a manufacturer sells 200,000 vehicles. Right now, Tesla and General Motors were the only manufacturers that the phase out applies. So you need to check, okay? And the clean vehicle credit actually is limited by the adjusted gross income. So you may need to be careful. And there's a list of eligible vehicles for this credit on the U.S. Department of Energy website. I can get you that and look it up. Okay, but this is pretty important. But again, you can also use it for used vehicles, and I would strongly recommend you look at that, because I think a lot of us are seriously considering electric cars. Okay, here's a question. Do qualifying medical expenses have to be above a certain percentage? Absolutely, they do. They need to be above 7.5% of your adjusted gross income for you to take the first dollar of medical. But again, if you're paying for a nursing home or something else, then the amount of money got enormous. I have people with $100,000 of medical expenses. But again, that question is a very good one. I tell people to look at their medical expenses, because you will be flabbergasted at how much you're spending. I have people that wonder why they don't have any money, and then they look at what they're spending for Medicare. They look at what they're spending for their supplement. They look at what they're spending for their drug bill. They look at what they're spending for their long-term care policy. They look at what they put out of pocket for all sorts of things, even things in the house like a stair lift because you can't do anything, or a lift to get a wheelchair in a car, or a special hospital bed. All sorts of things like that are deductible. And people are flabbergasted at how much they've spent on medical, and they wonder where their money is going. And again, huge amounts of money are going for medical. Now, actually, I want to bring something else back into the discussion with this. Remember, I told you about an hour ago now that in 2021, a lot of people had really big capital gains from their mutual funds, or their broker sold all sorts of things. So they were surprised when their income that used to be here went up to here, and they pay a lot more tax. One of the things that's been in effect now for about less than 10 years, I think, Medicare has had a fixed amount that for years that most of us used to pay. If you can remember back that long, it used to be about $104 per month. If you look at how much it is, it's about $160 now. But if your income is above a certain level, the IRS shares your income with Social Security and Medicare. And what I mean by income is this: it's your adjusted gross income plus your tax-free income, which is taxable in Illinois and not taxable on the federal side. It's called your modified adjusted gross income. If that number is above a certain amount, then you're going to pay more for Medicare and you're going to pay more for your drug premium. Let me give you a couple of examples. I have a lovely client, and she had oil mineral land in Colorado. I have no idea. She probably inherited it, and she was getting oil royalties for years and years. And she's getting up in age, and she sold part of it, and then she got an offer to sell the rest of it, I think last year or the year before. And all of a sudden, there was an extra $200,000 in her income that wasn't there the year before. And all of a sudden, she got a nice little letter from Social Security. I don't know if anybody's ever gotten one. They show up at absolutely the worst time of the year. They show up usually right around Thanksgiving, right when you're ready to do your Christmas shopping. And they say, hello, we looked at your income from your tax return this year. And lo and behold, this is now what you're going to pay in 2023 for your Medicare. Okay? And this is what you're going to pay in 2023 for your drug plan. So it's the base rate plus what's called an income adjusted rate. The good news is it's 1 year at a time. So if you had a problem 1 year, the next year it will go back down. And if you've had, and I had a client, I love this. Thank God she's not on this Zoom, but her husband is a doctor. He's a pathologist, I think. So he makes a lot of money. He is retiring in 2023. And so he's having a life-changing event. So he makes this much money, and now he's going to be down to making this much money. Okay? He doesn't have a pension. He works for a group that works for hospitals. And so if you have a life-changing event, you can petition Social Security and Medicare and say, hey, look, my income was here, and I was happy to pay Medicare more when I was here, but now I'm here. And usually they will go ahead and do that if there's a reasonable cause. But again, people are flabbergasted at how much Medicare can cost. it's costing a couple thousand now, and it can go up to $5,000 or $6,000 if something happens and your income jumps. So I think people are surprised about that. Yes, Medicare premiums are included as healthcare expenses. Yes, Doug, they are. They're included as part of your healthcare expenses. And so and in fact, you need to look at them and be surprised at how much they are. As I said, the lady that's still sitting here in front of you, older than I ever thought I would be, almost older than my mother was. My father died really young and the same age my mother was. And so I am still working. Some people say I'm a little bit crazy, but I'm really lucky to be able to understand this stuff and help you. And so I pay a lot more for my Medicare because not only do I have my retirement, but I'm still working at my business. And so I'm really lucky that I can do that. But again, Medicare is your Medicare premiums are part of your medical expenses. I think there are a couple other things I wanted to tell you. Let's just look. Hang in there while I look. Are there any other questions that I need to deal with? I think I want to talk about how to file your taxes and even what's going on with TurboTax or some of these places. And I want to give you some examples. And I'm not saying that I'm looking for more people. A lot of people say, hey, I can do my own taxes. Hey, I understand what's going on. And TurboTax, I think, I don't remember which football game they were advertising on. And I'm not saying they're bad or good, but I am really recommending a couple of things. That when first you need to gather all your stuff. Okay. 2, then you need to begin to understand the laws, which, as you can hear now, have sort of changed all the time. Okay. And 3, you need to figure out what you've paid and what you haven't paid. And let's talk about that for a minute. Okay. When you are working, and I don't know how many people here are working or not working, but when you are working, often all the money is withheld from your W-2. Okay, you have a salary, you withhold the money. Do you remember in the good old days when you used to be able to run to your mailbox and get your refund? Okay, it was cool. Okay, when you are retired, things change dramatically. You have money coming in from Social Security. You have money coming in from pensions if you have a pension. You have money coming in from IRAs. You have money coming in from investment accounts and from interest and from all sorts of other places. My term for that is called multiple income streams. And one of the things that happens is every single year, your taxes are different. So the year you turn 66 and start taking Social Security, or maybe later than that, then, and I'll talk about Social Security in a minute, then you might have taxable Social Security. When you start taking your required minimum distribution, then you've got more income. And so all sorts of things happen, and every year when you retired, life is different. So either the IRS has a funny rule. It says you have to pay 90% of the tax that's due cash on the barrelhead, or you get what's called an underpayment penalty. Okay, or you have to pay what's equal to last year's tax. What we try and do with people is get them as close as possible so that when we hit tax time, like now or in April, it's really bad if you get stuck having to owe big money in April, and then you're starting the next year and you just finished paying for last year. Okay, it's a mess. Or you sell something and you didn't realize you had that much profit, and then all of a sudden your tax person or you finish your tax return and you say, oh my God, how could I ever owed so much money? What did I do that was so stupid? You know, where am I going to get the money from? Okay, I have a friend who is also a client, and I'm not going to say whether I think she's bright or not bright, but you'll understand it. And she's been helping her daughter that's been out of work for years. So she's been taking money out of her IRA and then giving it to her daughter who's been out of work in Las Vegas because she won't get a COVID shot. And if she's a nurse and she won't get a COVID shot, she can't get a job. Well, I tried to figure out what she was taking out last year, and she took out $148,000. If you take out $148,000, it really screws up your tax return, and you owe a lot of tax. If you don't have any money to pay the tax, where are you going to take it out of? You're going to take it out of your IRA. So it's really important to figure out what's happening on this end before you get caught at tax time. I guess I'll give you another example, and this person will forever remain nameless. I think she was angry at me, but she shouldn't have been angry at me. Her broker decided he was gonna do a smart thing in 2021, and she didn't even realize what was happening. She was divorced, and in her divorce, she got half of the really good investment account that she and her ex-husband started together. So it was down here, and the broker sold it way up there. She had $500,000 worth of gains. Her tax was someplace off the cloud. She didn't even realize that there was that much gain. And I had to go back to the numbers from her divorce decree, which were in there, to figure out what the cost basis was, because it doesn't get what we call a stepped up basis when somebody dies. It starts when it was bought. And so it's really important to be able to know and figure out your budget about what you're going to pay. And we work very hard with clients to figure out what I call estimated taxes or withholding, so that you break as close to even as we can at tax time. And that is a very important thing, because often people get stuck and they don't have the money. Let me give you another example of that. Is there a bottom line difference? There is, oh, this is Wayne's question. Is there a bottom line difference between taking it out of each IRA versus one IRA? That's a good question. So let's assume you have some IRAs, say at Vanguard, and then you have an IRA, a couple of them at banks. I try and look with people and say which IRA is doing the least well. So if you've got an IRA that's earning 2% or less at the bank, and the Vanguard in the stock market's doing this, where would you take your IRA out of? And take it out of the bank. Okay, but it doesn't matter where you take it out of. But again, this is something that if you are going to a good tax professional, they would help you look at where you want to take it out from. Each investment person will send you a letter and remind you to take it out, but it doesn't matter where you take it out of. I have a client, excuse me, that's a terrific investor. I think he was pretty high up in William Wrigley, the gum people, a long time ago, and he manages his own money, does a terrific job. And he has one account in E-Trade that's very big, that he manages, and he has a couple of small accounts. And we look at it when I do his tax return and figure out which account to take it out of every single year. I also look with him about how much tax he should have withheld from his RMD so that he doesn't have to pay estimated. Now, something else that may happen for you that's in 2023, so you don't get scared, and it already happened to me. The stock market was like this, and then the stock market went like this. So that your required minimum distribution is based upon the value of your assets at the end of the year. I have one small IRA at Fidelity. Yeah, it's mine. It's not the one I inherited, but it's mine. And I had to take out $2,000 less than I took out the year before because the value of my IRA dropped 20%. Now, if you need the money to live on, you can take out more than your required minimum distribution, but then the money's gone. So again, if the value of your IRA dropped and then your RMD is less, it means you pay less tax, but it also means you have less money to live on. Now, I may not be living on all my RMD because I'm still working, but a lot of people count on their RMD to pay their real estate taxes, to go on vacations, to give gifts to their kids, to do something else. And so it's really a problem, but it doesn't matter where you take it out of. Now, given that I've said that, I'm trying to watch my time for you. Given that I've said that, there's something else that I do want to say. Okay, and this has to do with gifts. A lot of people ask me about gifts. Here's what happens with gifts. Let's assume, and I don't mean charity gifts, I mean regular gifts. So let's assume, I'll give you an example. I have 6 grandsons, 4 of my own and 2 step-grandsons that I inherited that are like my own. My oldest grandson is getting married to an adorable, lovely person in a wedding that they're having a glamping wedding. Glamping is called glorified camping. Don't ask. Grandma Judy is going camping. But I really want to give them money so that hopefully they can buy a part of money towards a down payment. If I give them more, if I give him more than $17,000 a year, that it's not a taxable gift, but I do need to file a gift tax return. Okay? If I'm giving the money to him and her, and there's just me, I can give them $34,000. I don't think I'm giving them a wedding present of $34,000. Okay? But I have people that give gifts, and we have to fill out a form called a 709, and it just sits there in the IRS. There is no tax until it hits $1 million. But if you give away more than $17,000, I have to file a gift tax return. And again, a lot of people, and I think this is a good idea. It depends how much money you have. Some people feel like they want to keep all their money until they're not here anymore because they're worried they're going to run out. Okay, and they'll give it to people that inherit it after they die. Or they feel like, hey, I want somebody to enjoy it now and I want to see them enjoy it. Okay, so I'll give them money and they'll buy a car, or I'll give them money and I'll help them with their college tuition, or whatever I'm going to do. I'll set up a trust fund for them, or I'll do something else. But a gift becomes really important, and I have lots of people do that. So are there any other questions? I don't think so. I also want to talk about one other thing, because, and some of you are young and some of you are older in this group, but I have to tell you, I've been doing taxes for a really long time. There are a couple of things that I want to say to my older clients and to you that are really important. A lot of people, and I got a phone call today, somebody's uncle died, and I don't even know who he is. I think he lives in Naperville, he works in Downers Grove, and his wife said, you have to talk to Judy. One of the things that happens is a lot of people don't want to think about getting their act together financially before they die. A third of us don't have wills or trusts. A lot of us have money scattered all over, okay, in different accounts. Some of them have online passwords. Some of them don't. Half the time people die and their kids or the person that's their executor or trustee has absolutely no idea where all the stuff is. Okay, it's a problem. Or they read the trust and they say, oh my God, I didn't realize that my mother had a fight with my sister Joan and she didn't leave her any money. That's pretty awful. And the mother's gone. And maybe you had a fight with one of your kids 20 years ago, but you never changed your will or your trust and you knocked them out of it. A will or a trust is a legal document. It says what's going to happen with your stuff. It's really important. Okay, somebody's, the 2000, yeah, the limit has been for 2023. Somebody just found it online. Anyway, your will or your trust is seriously the roadmap for what's going to happen. Your IRAs also should have beneficiaries. I have a client, the same client that I was telling you about that manages his own IRA. He had no beneficiaries. His IRA was worth over $3 million. 2 years ago, I spent half the summer with all of his different IRAs, making sure we had the beneficiary. He's in his 80s, making sure we had the beneficiaries forms filled out, all the way down to his great grandchildren that were getting 1 or 2% that were going into trust. Okay, all of these things are pretty important. And it's not just the financial stuff, I have to tell you. Unfortunately, I have people, somebody dies and they're fighting over the Yadro collection in the house. They're fighting over the jewelry because nobody said who's getting what. Okay, it's really not clear. And so no matter what happens, this thing needs to be looked at. I have people whose trusts and wills are 20 and 30 years old, and the laws have changed dramatically. I am strongly, I'm looking at the time, I'm strongly recommending that you look at what you have, that you talk to a good attorney. If you're a client of mine, I'm happy to recommend attorneys. Otherwise, I can't do it without you being a client. But some people come in for consultations and we take a look at these things and I see where they are. The person who called today said to me, oh, it's a really simple blah, blah, blah. Well, he started talking to me. Where did his uncle die? His uncle died in California. His uncle had a condominium in California that he bought for $300,000 and sold for $800,000 in 2022. Might there be tax on the condominium? Probably there is in California. Okay, somebody inherited the money from the condominium. It's sitting in some account in Chase, apparently. Okay, there are at least 15 beneficiaries from these investment accounts. I haven't even looked at the IRAs yet. Okay, nothing was ever done after he died, and nothing was converted to what's called a trust, an irrevocable trust account. So he said, oh, there isn't much money. Well, there is, but there's a huge amount of work, you know, that somebody has to do. So that if you are younger, you've got kids to worry about. If you are middle-aged, you still hopefully have your spouse to worry about. If you're older, you've still got your adult kids to worry about. And we spend a huge amount of time in my office talking to adult children. They're paying their bills. They're deciding what they're going to do in a nursing home. They're dealing with the stuff after they die. So there's all that. I have only one other thing I want to tell you, and this is something that's pretty important. You and I and the IRS have been dealing with identity theft for quite a while. I guarantee you there are 35 people here. I guarantee you there are at least 5 of you that have had your identity stolen. You've had your bank account hacked into. You've had credit card stolen. All sorts of things have happened that you don't love. Or perhaps somebody has stolen your social security number and filed a tax return under your social security number. That is what's called identity theft from the IRS. It's happened a lot, okay? It's easy enough to get, unfortunately, and they've been trying pretty well to stop it. If you had identity theft with the IRS, you are required to have what's called an identity protection PIN. It's a number that's given to you by the IRS that either you or I have to put on your tax return that says this is who you are, and you are who you say you are, thank God. And the IRS knows, even if they got another tax return, that person isn't you, and they can stop that person. Usually what happens is people file early, they get the refunds, you file later, and there's a problem. You get an identity protection PIN, either with a form that you can mail to the IRS, or on the phone, or best, you have to get it online. Now, you don't have to get it if you haven't been hacked, but a lot of people are worried and they are getting it just in case. The biggest part of these identity protection pins is that once you get one, or once you are required to get one if you've been hacked, you have to get a new one every single year. I'm going to say that again. Once you get it, you have to get a new one every single year. So if you show up in my office, or you try and file your tax return, and you had one last year, your tax return will not be accepted without an identity protection PIN. I think, I won't think we had a divorce in my office last year, but I had a client that's been a client of mine for a long time, and he decided, without telling his wife, that he was going to do it. And you can get one for you and your spouse, or one of the two of you. It's up to you. So they were sitting in my office, and he said, "Oh, I have my identity protection PIN." And she said, "You have an identity protection PIN?" And I said, "And when did you get it?" And he said, "Last year." And I said, "Do you have this year's?" "Oh, I didn't know I had to get a new one." He tried to do it online to get a new one. He couldn't do it. I thought they were going to have a fight in my office. Eventually, they came back to my office for a second visit, and I helped them get an identity protection PIN, and they had to pay me to help them get an identity protection PIN. So we have a list of all the people that have identity protection PINs in my office, and we send them reminder postcards so that they're not showing up in my office without one. We also, in my office, have a list of people that pay estimated taxes, and we send reminder postcards because it's easy to forget. It's easy to forget to pay estimated taxes. It's easy to forget often to take out your required minimum distribution. Somehow, as we get older, it's easier to forget that we need an identity protection PIN. And so all of these things are really important, whether you do it yourself or you hire a tax professional to do them. Now, the other flip side of this on a tax professional, and I have about 4 minutes that I want to tell you. And this is a very good, it's an awful story, but it's an important story to hear. I have clients that I've had for years, and they called me up. I think she sent me an email in the summer. Her mother was having her tax return done, and I won't say by whom, but by one of the commercial tax return people. Her mother died in 2021. They always brought the stuff to the tax professional in the office. Somebody did the taxes. They signed, they assumed it was okay. I think she died in 20, maybe. In 2021, they got and the house was gone. Okay, the mother was dead. They got a levy notice from the IRS for a huge amount of tax, a huge amount of penalty, and a huge amount of interest. What I discovered, and she went back to the person, to the organization that did the taxes, they didn't do anything. Okay, nothing. Apparently what happened is this business that did the taxes forgot a mother's $55,000 pension from the state of Illinois in 2018. Okay, it was on a form called the 1099-R. The IRS does match everything they get electronically with everything you get in paper. It takes them 2 to 2.5 years to do that matching. They send you a letter. Obviously, the letter never got to anybody because the mother was dead. And so they sent a levy notice with the tax, interest, and penalties. Okay. I got a transcript from the IRS with every single 1099. I found out what happened. I prepared a completely new tax return, and my clients, the daughter, paid the tax. We are still fighting about the penalties and interest. If you remember, I told you at the beginning of this wonderful session, we sent a letter into the IRS with all the backup and all the problems. And I've been trying to work with the power of attorney with the IRS for about 6 or 8 months now. The good news is I also last week emailed the company. They're based in Kansas City, so you probably can figure out who they are. Believe I couldn't call them. You can never call these people. But I emailed the CEO of the company that I found online. The daughter hired me to do all this work. Okay? I got an email back within 2 hours from somebody in the executive office. I have now sent them all the information with the penalties and the interest and the tax. We believe I'm going to save my client almost $4,000 in penalties. Okay, that this company, which is a big tax company, is gonna make them whole on the penalty. Okay, and so a good tax professional goes from here to here and goes the full 9 yards for you, because that, and I'm not saying I'm wonderful, but that's what a good tax professional does. And otherwise they would be stuck for the money. So whether you do it or you hire a good person, I think this year is going to be interesting. I will honestly tell you that I am in favor of the IRS getting the money that is in the new bill that has been appropriated to get new computers, to hire new people, to develop new software, to answer the phones, okay, and to get things cleared up. We are hoping that this year will be better than last year, and I wish you luck as you work on your taxes. If you have any questions that are generic and not individual, you can email me at judy@strausstax.com, or you can call the number in Downers Grove. We have now ported to a cell phone. It is 630-964-4018. It's on the cell phone. And either I or my assistant, her name is Beth Austin, will answer, and we always call you back. I want to thank you all for coming. I wish you good health and have a good year. And Xavier, thank you very much for having me here. Believe me, I really love to give back to the communities where I raised my kids and where I worked at Benedictine University for so many years. Thank you all for coming.
Thank you, everyone. And this has been recorded and will be available on the YouTube site. I'll say soon in quotation marks. We have lots of things going on here at the library. Thank you again, Judi Strauss, and thank you to everyone who attended. Have a great evening.